And I won't keep you on any longer. I took up a lot of your time, but
Well, there we go. Finally got it up and running here. Good afternoon, everybody. I'm Dan Hussey with Zaner Ag Hedge, bringing you a Strategy of the Day update here for August 20th, 2021. Got off we just wrapped up a interview and a little recap I did with our Chief Market Strategist, Ted Seifert here. I urge you to check that video out. He gave us a rundown of what he saw. He was our boots on the ground out in the field for the Pro Farmer Crop Tour, running down what he saw in terms of yield, how impressed he was with the corn crop in some areas. Yes, it's not perfect, but yet it is yet another data sampling. And you can't deny StoneX, USDA, and now Pro Farmer Crop Tour all giving us yield estimates, which the USDA is obviously a little lower, but where they were before they reduced those yields from their surveys obviously was right in line with where we're seeing those today. Lots of pitfalls in the numbers that we see. It's not every field. It's, of course, the same fields year over year. And really what's important to look at is that delta or the change year over year and relative to how that could, play out for the rest of the country. Nevertheless, you can't argue with price. That's the only thing in this market that matters. Yield forecasts, weather, everything else is just noise. The only thing that is right is price. And I think the price of this and the trend that we're seeing going lower in the grains right now, if you're not listening to it and in denial of it, you need to have a hard look in the mirror of what you're trying to accomplish in the market. You have two types of traders, those that want to be right and those that want to make money. There's a stark difference between the two. Of course, we're on that side and like to be on that side of wanting to make money here. And at the end of the day, while the futures account for hedging purposes and marketing strategies isn't where we want to make money, it is where we need to put a plan into action that looks to protect our downside risk more than anything. And days like today are a great example of why that plan needs to be discussed, put in place, and acted on ahead of time. Now, there's still plenty of opportunity to protect pricing. It's obviously now that we've dropped a little bit, that type of idea changes. Yesterday's Strategy of the Week outlook, I took a look at some actionable option strategies where we sold calls to buy puts to try to do a risk reversal type of strategy to help finance the increasing cost of puts at that time. The market's broken here today. I personally think, as we'll go over here in a few minutes, that we might have a little bit further to go, as I've been discussing over the last few weeks in these videos. But remember, trading futures involves risk and is not suitable for all investors. And everything I do talk about here today is just my own opinion and not a direct trade recommendation. The first clue that the markets might have been wanting to head lower has nothing to do with the grains at all. We've been looking at the US dollar here in terms of what it might clue into us in terms of exports. And over the last week, we've seen a very strong dollar rally. The dollar now above the 93 figure and above the high end of the range that we've been in since the start of February might be signaling a further dollar strength that on the back of our the Fed announcements over this last week that we might need to assume a taper is coming down the road. And what that means is the Fed is artificially keeping rates low by giving money away to banks effectively. It's not that simple, but more or less they're able to keep interest rates low by giving banks liquidity. That process ends up causing the US dollar to typically drop. And if interest rates can't go lower, which they effectively can't when they're at or near zero, which we're above 1% in our 15-year and such. But the point of the matter is they can't go much lower than that, or shouldn't really. So the big effect that it's going to the Fed's policy and the talk of a taper where interest rates would likely rise, or really asset purchasing that the Fed is doing would be reduced, and that's a precursor to rates rising. That is all dollar positive, and that's something we're seeing play out in these charts. So that stronger dollar trend we're seeing, that weighs on commodity prices and any type of price, any commodity that's priced in US dollars, and particularly those that have strong export markets. This time of year, you can see how wheat prices have responded to the recent rally over the last couple days in the US dollar. That's a good example of where I believe both the price rationing of demand here, because we've, demand destruction has now set in with high wheat prices, coupled with a rallying US dollar, have caused maybe a bit of a top to form in wheat. Are we going to fall that far? Well, wheat's in a pretty good channel here heading higher. we did break trend line support, and we know we've got 50% support just below that $7 figure. I think at this point, testing $7 is a good start to finding support. And below there, we could trade all the way back down to the low end of this range, around $6 to $6.20, where Chicago wheat contract might find more support. This is just a good example of a market doing technical things. It's still very fundamentally bullish. We still have tight carryouts. We've seen decent exports for wheat, but some of the headwinds that might play into that are a stronger U.S. dollar. That translates onto our soybean market in another very real way. Let's take a look at the daily soybean chart here. Kind of been I feel a bit like a broken record over the last several weeks talking about the range that we've been in, some of the trend line support that we've been holding, and now the market's starting to break below that trend line support. Where are some of the downside targets we should look at? I've been pretty adamant in the idea that if this market breaks down, there are key levels to watch. It's starting to go through those levels. And if this market continues to break down because, for whatever reason, I would attribute this to China buying cash and then selling futures, making the trade break, getting a lower price, cost averaging in on those cash purchases by making money on the futures board. They're doing nothing different than producers are trying to do. Just an opposite. If they are trying to buy the lowest prices possible and protect from rising prices and rising cost of acquisition, China's best interest is to sell futures on the board to hedge that type of acquisition, right? Just like as producers and farmers, we're trying to manage our risk by putting in a floor in the market and leaving that upside open, for better prices down the road. Nevertheless, today we broke down below the $13 figure. We're below the trend lines that held us up. We actually broke below those yesterday. A big reason why I felt the downside might be starting. Now that we're back below the $13 figure, closed the week below $13, closed the day, and really have a lower low and lower highs now going into not only daily now for the fourth day in a row, but also lower lows and lower highs for the month of August compared to July. It's not a great technical looking chart. We're coming up on that and actually went through this, I'd say, a little bit weaker trend line support here that was right around $13. So now those levels to the upside might be resistance, and we'll look at those on the smaller time frame chart here just in a second. The 1240 area, we've been talking about this. It's simply the prior lows from the month of June. It's the 200-day moving average. That's probably the next level of support that this market's going to be seeking out as we are currently in a period of price discovery lower. This has nothing to do with fundamentals at this point. The market hasn't had anything to do with fundamentals for quite some time. We've had how many, almost 3 weeks of solid flash export sales, 2 million metric tons sold and confirmed, over 2 million metric tons sold and confirmed on our weekly export reports. Yield numbers being reduced by the USDA, and the market can't rally. So the market isn't responding to fundamentals. So we need to stop looking at fundamentals and think about what the market is actually saying to us. It's about listening at this point to what the market's saying rather than trying to force our opinion on the market and what we want it to do. So with that being said, this downside from a technical perspective makes a lot of sense. It doesn't make any sense from fundamentals, and that is absolutely one of the most frustrating things for traders this time of year. Seasonally, however, we can make a case for the market getting leaned into with harvest pressure and all that good stuff. We're not into the harvest yet, so you wouldn't imagine those sales being too heavy just yet. But the idea that we could form a harvest low this time of year means that prices need to break to find a low. And that's probably what's going on right now. Again, 1240, not an area that I would necessarily step in and be a buyer outright, just, certainly on the first touch or without watching it trade into these levels first. But as we come down, and what we'll need to do, and we'll look at it on the smaller time frame chart here in a minute, is try to figure out where some of those levels and how this trend might break and turn back to the upside. So we've got a good idea of where some of those larger time frame charts say that levels might be. On the 4-hour chart here for soybeans, I can make a good case for this $12 to $11.50 range. It's the old cluster of highs and lows we were holding into the end of 2020 that we broke out of here into 2021. And that comes in the lows here for 2021 in March. After we broke out of that level, we're counting right around 1182. Equal legs down, you measure this first break from 1480 down to the 1240 lows. extend that from our range break high. The highs of the range in a break lower could take us down to 1183. Extend it from about the median of the range, that could take you down to 1140. The full 50% retracement from lows of 826 of last year to 1480 highs come in at 1150. So we have this big cluster of technicals down in that below $12 that if we got down there, not only would I say from a technical perspective, we've got a reason to find a bottom, but I also believe that we would have enough of a drop in price to really entice demand. Not that we need to, it's just China would, I think, feel a lot more comfortable buying beans $2 lower than where we were today. And if they're not, they're probably short the market, betting on the market going down there in the futures with a hedge on against the cash purchasing they did. All that being said, we are now through the lows from our pre-WASD report. We went below those levels yesterday. That was certainly a level that we were worried about the market getting below and staying below. And sure enough, today we got leaned into. We're now below that July 5th low where we had that pretty nasty decline and below the lows that we had held for the month of August. So now, again, lower lows, the blue lines here are the highs for the month of July and August respectively. The red lines, highs of August or July and August respectively. And now we're making lower lows and lower highs on the monthly time frame too. So unfortunately, no matter what we think about this market, it seems to be trending lower at this time. And we have to respect that. The trend lines that we broke below, they're clustered between the $13 and $13.20 area. This is where I would say we've got our next kind of resistance area if the market wants to bounce back here as it kind of did into the close. I'm looking for highs into the $13, $13.20 area. I know it's a little bit of a wide range, but there's lots here. There's prior lows. There's trend lines against the highs, as well as the old broken trend lines here. First as support, now as resistance. So again, I'm looking for this market to continue a little bit lower here now that we've broken through some key figures. But you can't deny we are still very much in a very large range. And at the end of the day, we might just be carving out that range still. So today's low could certainly hold. Can't deny that one bit. But now that we're starting to break, is this the harvest low that we'll find? We'll see. But again, if we start to break lower, got a nice big area down here that I would almost welcome at this point to trade because I'd love to get some re-ownership strategies going on down there. It's not too late to try to get some price protection on for a more of a decline and certainly to get sales done. We're still talking about sales above $12. These are better levels than we've... Sorry about that, Bell. These are better levels than we've seen over the last 5 years to get sales done. So, you know, at the end of the day, you can't be too greedy when we've spent, 6 months up here above $13. Well, 3 months above $13, giving plenty of opportunity up until this point. I hate seeing a market break as much as you do, but we have to keep a plan in place to protect ourselves for that downside if and when it comes, and it seems to be in the works. The very small time 15-minute charts here, we got trend lines against the highs. Again, those cluster around 1320. We've got a more aggressive trend line that we could hold this recent decline today from. It's in 50 back against today would take us up to 1305. So the $13 level, the 1320 level, kind of the two resistance zones that I'm expecting if we trade back to might hold before more downside sets in. Our corn market, December corn here, still in a big range. Did not break. I mean, it broke down considerably today and is following through from yesterday's sell-off, but not a breakdown like we saw in the beans, right? You can make all the arguments in the world about how pro-farmer came out and yields are better than expected and whatever, and the market's breaking because of that. But the truth is that this just looks like a market that failed to break out, failed to break above $6, just like the beans, failed to break above $13.80 in some trend lines, and traded a technical sell-off back into the range. So because the fundamental picture is still there for upside, I'm still in the camp that this break and any downside in price we see is an opportunity for re-ownership. Now, before we get to that type of discussion, we have to discuss about how we protected our downside, which is a big reason in the last strategy of the week update and in some other videos recently. I've been talking about some of that put protection that you can still get on or could have gotten on before this happens, because ideally you'd love to have that floor in your price in place that then we can come in and own something below against that then is leveraging whatever, for example, if you use one of these weekly options that might have gone into the money today or could be in the money next week at expiration, you're going to have a short future from that level. Well, that short future gives you a great floor in price, right, as would an HTA if you're selling that future with your elevator on a hedge to arrive strategy. Well, this type of drop in price now gives you the ability to use the board to come in and scoop up with a call or something to that effect, and leveraging that short position you have on the board, certainly in a futures account. If you've got that position on the same account, you could even come in and buy futures. In this case, if you ended up short the board on August or September, I should say, for beans or corn, it would make sense to come in and buy a December or November future against that and be spread the market if and when it ends up bottoming out. You can also take profit on that call or on that short and enter into a call spread. There's all number of ways of trying to reverse that opportunity and then reopen your upside from a lower price after you've gotten that protection on. So trading to me and marketing to me is all about first having the discussion of how much money can we lose if we don't do anything, and then we can have the discussions about how much money we can make if not only the plan goes to work, but also opening that upside back up. So all that being said, December corn now down below the 55-day, 100-day, and 18-day moving averages. That 100-day moving average was a very supportive line in the sand here for me. Breaking below the 550 area, I do think we are heading down to a test of lower trend line support around $5.20 to $5. Below that area, we've got a 496 200-day moving average at this time. And let's just get right into our shorter time frame charts. Start with that 4-hour December corn.
14 cents December corn and another 13 on wheat. But hey, let's catch up next week.
That old trend line resistance I've been talking about for some time against the highs. We failed to break out, failed to break above $6. We fell back into the range. There was trend line support against the lows here, which aligned with that 100-day moving average that we went through as we broke below 50. Now that we're below that line, we could still very much just be in a sell-off inside of a larger range. But at this point, and once we get below this 530 area, there hasn't in the past been much support until you get back down to $5, and that's what I'm concerned about at this time. So much like the soybeans, if you take an equal measurement of these levels, or a measurement of this first decline from 638 down to the 499 lows, you extend that from either one of these highs down to find where what we refer to as equal legs lower would be. That would take us on a move down towards $5, to 480. There's that open gap at 477. There's now there is a bit of a trend line here that does come in around the 520 area. So I am still very interested to see if this market can't get some support under itself on a move down to 520. But it does look like into next week we may, and certainly if the market gets leaned into because of this pro farmer tour number, 530 might break to the downside and open the door for a test of I'd say it's about at 515, I guess, this trend line support, and that aligns with this broader area. But again, I think a move down to 477 to close that gap, clean up the chart would be welcome to me at this time, just to be a better bottom that then we'll rally from, and then head up to, then start a market move like we saw all of last year that made sense in corn and beans. It made sense for them to rally. Every fundamental aligned here. We even went into into the start of this year had, not terrible planting issues, but there was enough issues in some places to talk about late planting. All that being said, the full 50% retracement from the 357 low to the 638 high comes in. Excuse me, right around $5 at 497. And so at the end of the day, a pullback into that area just seems like a logical supportive area at this time. Below that, we can talk about the 450 to 420 area, but I don't think the market has it in it to get down to the low fours this year. But I could be wrong. But I do think this drop is one to think about buying. So full 50% short here off the highs. 56 or 560, excuse me, area. I wouldn't say we were going to get up there. 50% short on today. Could be resistance up around 545. Yeah, look at this prior low here at 545, the low from our WASDE report day at 550. I'd say that while we're below 550 to 545, look for resistance into that area. That's also the low end of this range lows that we held going into the WASDE report, around 545 area, and certainly those lows at 540. Basically, a lot of resistance now to chew through on the way back up for corn. At some point, I think it's going to. Trendline resistance here against the highs is coming down around 550 at this time. There's maybe another one up around 555. But again, we're going to have to do some work to get up there at this time. So that pretty much wraps it up for me here today, folks. Check out my strategy of the week update where I go over some of those puts that we looked at. Unfortunately, things have already broken down today. Be coming back at you next week with another strategy of the week update. Sign up for that webinar here in the links below in this, either in the comment section or in the, you'll find them on there. But with all that being said, have a great day, everybody. Have a great weekend. You can be reached over here at Zaner at 312-277-0110. Find me on Twitter or here on Facebook at Dan SOTD. Feel free to subscribe there to make sure you get all of these Strategy of the Day updates. Shoot me an email if you've got any questions or concerns about the market. I'm here to talk with you about all of these marketing ideas and strategies I'm trying to put to work for you. Have a great day, everybody. Sign up to the link below. I'm trying to get through everything here. Sign up in the links below to receive our Zaner Daily newsletter to get our entire team's commentary on current market conditions as well. Have a great day, everybody, and we'll be back with you as price action develops. Did I mention you should have a great day? See ya.